Hi, I'm Ross Mayfield, investment strategy analyst at Baird, and we are back for another weekly update with our friends at Strategas. Today, I'm thrilled to be joined by Strategas president and head of portfolio strategy, Nicholas Bohnsack, to talk through all things markets. But first, Nick, how are you doing today?
I'm doing very well, my friend. How are you?
I'm doing great. Thanks for asking. I want to get started with just your high level market take. We had you on the mid year outlook video for Baird. We got your all's updated thoughts then, but another month into what I think is a very unexpected rally in 2023 amid broad calls or expectations for recession and some market struggles. And yet here we are up roughly 20% year to date. So with that backdrop, I'm curious, what are your updated thoughts on this market and where we might head into year end?
Yeah, well, it's certainly unexpected from our part, and I think we own that. We've been more cautious, as you know, on the economy in general, but it's very difficult to sort of look at what the market has done year to date and call it anything other than at least a strong patch. And as we did speak about, I think in the mid-year outlook, the two questions that present are: is it more than a strong patch, and can it last? And so from that end, when we look out towards the end of this year, we are definitely seeing some green shoots of improved cyclical activity, and in large part, that is backed by the continued strength in the labor market. And even though there are cracks that are present, the reality is labor remains strong, and so consumption remains strong. And when you generally have sort of that universally positive feeling, and you can see it manifest in the retail data, it tends to bring the stock market right along with it. And I would tell you that if we had this conversation 2 months ago, closer to the end of May, I would have been more suspicious about the durability of the strong patch given the narrowness of the leadership profile. But truth be told, it has broadened out, and it's broadened out into the industrials, it's broadened out into the consumer segment in terms of stock market leadership, and it's even started to include energy. And so there are some pro-cyclical overtones to this rally, and it gives us some confidence that it does have some room to go. On the other hand, there are certainly concerning elements from the broader economy. It's not an equilibrium. We have to be mindful of that. But we don't want to look a gift horse in the mouth. This has proved a very attractive opportunity for people to get involved in stocks. I think it's okay to do so. I would do it, however, with some with some discipline and be ready to pull back should the economy start to fade away.
Yeah, I think that's a great way to think about it, especially sitting atop a large rally where sentiment is getting more bullish, and as we head into a seasonal rough patch. But broadly, you mentioned cyclical green shoots. The cyclical sectors have started to outperform, and you all made some changes to your sector allocation recently that I wanted to discuss a bit, and in particular, upgrades to industrials and consumer discretionary, to very classical cyclical sectors. Could you dive a little bit deeper on those for me and explain what prompted that change?
Yeah, for sure. And again, we've missed a little bit here from Memorial Day, though we made those changes as you speak to. I think this articulates the importance of having a financial plan and sticking to it. And the key really is, what level of comfort do you have as an investor, or might an advisor have, in tactically making some adjustments along the way. And so when we look out a year, Ross, which is generally where we as our sort of recommended sector horizon, we still see an economy that is not, as I said, in balance. It still probably has an elevated likelihood of moving into recession. And that does call for a slightly more defensive portfolio construction, particularly on the equity side of the ledger. And so, we look at things like healthcare, we look at things like industrials, and look at things like energy as having the intrinsic value and the operating profile to perform well during a slowdown in economic growth. But at the same time, as we mentioned a moment ago, there may be sort of this 5 or 6 or even slightly longer month opportunity where the stock market continues to melt higher. The economy hasn't, while in balance, may not have reached a tipping point. And that invites some allocation opportunity for folks that may be more tactical to invest in consumer shares and technology shares along perhaps with industrials. So you mentioned too, I think what's interesting about the industrials and discretionary sectors both is that they are the most diversified sectors within the S&P 500. All of the other sectors do something very specific. And then you sort of get to these two potpourri categories. If you're a business and you do business with other businesses, you're an industrial. And if you're a business and you do business with consumers, you are a discretionary sector constituent. And so what happens is when you invest in those two sectors, you get a very diversified mix of businesses. Some of them are working quite well, some of them less so. On the consumer side, it's interesting, hard lines have done well here. The home builders have obviously done well in here. And it's a commentary, I think, to the extent to which labor has remained strong. And of all the components of inflation that have been worrisome, the one that has probably kept the Fed in the game, and we'll see, has been the increase in wages. So if folks are making more money and the headline levels are coming down, it invites more consumption. We think you have to sort of row along with the tide with consumer discretionary as labor remains strong. And then with respect to industrials, here's an interesting thing. A lot of these businesses have figured out how to pass on price. And as the global supply chain dislocation from COVID has really been alleviated entirely, there aren't those bottlenecks anymore. So they're taking price from intermediate and raw materials, but they're also passing price. And so industrials is one of the few places that we see across the S&P 500 where within its collection of businesses, you're actually seeing margins improve. Will that be sustainable? I think we still are looking for those organic drivers of growth that are going to invite more capital into the market. But for the time being, industrial franchises have managed the fundamental profile really well. And where you see margin improvement, usually stock prices follow.
That's great. And I think really good color for anyone who's interested in those two sectors or why the market writ large is continuing to outperform. So Nick, I want to thank you so much for the time today. I would say to anyone listening, please check out the sector update posted on bairdwealth.com or check out Nick on the mid-year outlook posted to Baird's YouTube page. But again, thank you so much for the time and for the insight as always.
Appreciate you having me. Thanks, Ross.